Hello and welcome to the Finance Quarter. I'm Andrew Robertson, coming to you from the University of New South Wales in Sydney. And the reason I'm here is to speak to the Head of Risk and Actuarial Studies, Professor John Evans. With 2012 shaping up as another bumper year on world financial markets, our superannuation funds are also heading for another disappointing year. But Professor Evans believes it's not just the market to blame for super funds not delivering as they should. He thinks the funds themselves have a lot to answer for. Professor Evans, you believe that most super funds don't actually add value for the majority of their customers. Why do you think that?
Well, I think they've lost the plot a little bit. They were originally set up to provide basic benefits to take the superannuation guarantee levy and invest it for their members. Now they've become almost financial institutions in their own right.
Can you elaborate on that? When you say financial institution, what do you mean by that?
They're providing a very wide range of services. They provide banking services, they provide a very wide range of investment services, which is outside what their original brief was.
So how does that affect their performance as super funds providing retirement income for people when they stop working?
Well, the more complex the organisation, the more the costs. And somebody's got to pay for that at some point. So they must be more costly to run.
And that's coming out of the retirement incomes of their members?
Yes, it has to. There's nowhere else to come from. They've got no capital.
You've been particularly critical of industry funds. Why is that?
Well, I think they were originally set up just to invest superannuation guarantee money. And they're the ones that have become almost competitors to the retail sector. The retail has been set up deliberately to be a very wide service financial institution, and they're run by shareholders, and that's perfectly fine.
But surveys consistently show that industry funds regularly outperform the for-profit retail funds. So by your definition, retail funds must be doing something wrong as well. I
think their costs are higher. They're providing certainly a wider range of services. And their costs are therefore must be higher. But my point is that the industry superannuation funds could actually have lower costs than they currently have. And by definition provide better returns to their members. Yes.
So in your mind, what should a good super fund look like?
For the majority of members, it would be a very simple product. In fact, we actually had it when the industry fund started. We had what's essentially a bank account. Now, it wasn't invested solely in fixed interest, I'm not suggesting that, but it was invested and they then produced an interest rate. Members understood that. It was very simple, straightforward, and it was I wouldn't call low risk, but it was lower risk type investments.
People watching this interview will be wondering to themselves how they should respond to your comments. What should they do?
I think they should be engaging with their superannuation fund, heavily engaging to ask what they're doing. And is the product they're investing in the right one for them? It actually isn't as hard as it looks. I think some of the funds make it look hard by the very complex options they have. For the majority of members, they want a fairly simple, we call it balanced, so it has something in the share market and something in fixed interest, and nothing too sophisticated.
So is the real message that you really need to engage with your super, and particularly in this era of super choice, where most people are just pushed into a default fund?
Oh, I certainly would encourage members to get engaged and to ask the right questions. And I would be stunned if the industry funds don't respond to that. They want to engage with the members. So it's a two-way issue. If the members don't ring, that's it.
But most people are just in the default fund, a huge majority.
Yeah, I think it varies by fund, of course, but 70–80% is the typical number I'm hearing. I think that's low. I think it would be much higher than that in a lot of funds.
So how does that situation change?
I actually don't think they should be engaging with choice. I think they should engage with the superannuation fund to say, hey, I just want a nice simple product, thank you very much, nothing too complicated. Instead of and there are a few members who do want the choice, and that's fine, but they should pay for it, not the bulk of the members.
Professor Evans, thank you very much for your time.
Thank you.
Well, while superannuation funds have been constantly in the headlines since the start of the global financial crisis, so too have banks. It was the collapse of Lehman Brothers in 2008, of course, which nearly brought the world's financial system to its knees. Lehman's also focused attention on how banks around the world are regulated. On that score, we've heard a lot about Basel III since then, but what is Basel III? A man who knows is KPMG's head of banking, Andrew Dickinson.
So Basel III is the latest round of banking regulation which has come out of the international banking regulator in Basel. The first round came out in the late 80s, the second round in the early 2000s, and then this third round has really come out in the last year or two as a response to the stresses and strains that the global banking industry was under through the GFC. So the key features of Basel III really are around strengthening banks' balance sheets, number one, and number two, improving the amount of cash on deposit that they hold and other liquid assets that they have to be able to meet their obligations when they fall due. So it's really about having a stronger capital base, more capital and better quality capital, and by that I mean share capital and retained earnings as opposed to complex quasi-debt instruments which previously were allowed to be classified as capital, and also having a greater quantity of capital on hand relative to their balance sheet. On the liquidity side, it's really all about holding more readily liquid assets which banks can sell very quickly if they need to be able to repay deposits that their depositors may call upon. Well, I think it's inevitable that we will have future banking crises. Banks are very leveraged to the economies that they operate in, and when economies are under stress, banks are under stress. But I think that having a stronger capital base, having more capital resources available to absorb future losses, and having more assets that banks can sell quickly when they need to be able to meet their depositors' needs, will make the banking industry safer moving forward. Inevitably though, there will be some unintended consequences as well, because really this will put bank profits under pressure, which may mean that banks will have to pass that on through their pricing, and inevitably also it will make it harder for banks to lend as much as they have in the past. So it may make it more difficult for households and businesses going forward to get access to bank funding.
Social media has well and truly become a way of life for the younger generation and enlightened businesses. But like anything in life, you can have too much of a good thing. Social media commentator Laurel Papworth believes the recent tragedy involving the Italian cruise ship Costa Concordia points to a medium which could be getting out of control with big implications for business. Laurel, as you saw the use of social media on the Costa Concordia as it capsized, that raised real concerns for you. What were they?
I think the fact that first of all, it's a sad story about the cruise ship, but one of the more interesting things was the sister of the head waiter put up on Facebook hours beforehand that the waiter had spoken to the captain. He was going to bring the ship closer to shore so that they could all wave and say hello. So Facebook, in a sense, preempted the disaster before it happened. And then the second thing that happened was a woman, again on Facebook, said that while she was trying to pull men into the lifeboat, other members on the boat, including men, instead of helping her, were filming what was happening. In other words, live streaming or taking photographs or putting up online what they were seeing. And I think there's a number of views here. One is, are people that callous that they'll leave people to drown in the sea while they film their lives? But perhaps the other side of that is that in our last moments, we don't know what we would do. If a plane was crashing or if a boat was crashing, would you try and get in contact with your family members and put a status update to all of them? Would you prioritise one of them and just call that one person? Or would you drop the phone and try and help people even though it might be the last thing that you do? So there's some very interesting ethical questions coming up at the moment.
From what you're saying, it sounds like you think we may have lost the plot in that situation.
I think we're still sorting through some things. It's a typical question for journalists as well, because the journalist has to decide to put the camera down and help people in a riot on the streets, or to film it and document it. Coming back to the sister with the Facebook page who put this up beforehand, she continued for hours documenting what happened and saying it was the worst day of her life and everything like that. I didn't see anything there where she felt that she was responsible, which of course she's not, but it would cross my mind that if my brother-in-law wasn't trying to wave at me, would the captain have brought the ship closer? At the end of the day, the captain is responsible for that cruise ship, but that's something that I think companies in the future will be facing, is these extended conversations into family and friends.
We're obviously talking about a very personal tragedy on that ship, but as you've just alluded to, in your mind, there are implications for the business community in the use of social media during that tragedy.
Yes. Coming back from the crisis there, you can educate your staff and tell your staff what to say and what not to say on social media, give them permission to do things or not give them permission. But the minute they open their mouths at home, you don't have control over husbands, wives, kids, extended family, people they've met at barbecue, or in a sense, even people eavesdropping and overhearing something. I remember being on a plane and hearing two bank employees discussing their bank in front of me and thinking they have no idea that I could go and tweet 30, 40,000 followers, whatever it is I have on Twitter, and tell them the inside story of what has been happening in this bank. So we have these very public, transparent conversations where we think that we're being private. The invisible audience is not obvious to business or employees or family members.
Is it a matter of developing etiquette in social media and raising people's antennae so they know that if I hear this, I have to keep it to myself, don't put it on social media and things like that?
Do we need an Ita Buttrose of social media? I have some questions around etiquette because society normalises itself and says what its behaviours are appropriate or not. So what was appropriate in the 50s and 60s wasn't appropriate in the 70s and is definitely not appropriate today.
It would never be appropriate, though, would it, to reveal corporate secrets on social media?
Did that young woman saying that the cruise ship was being brought closer, is that a corporate secret, or is that something that should never have happened, never been done, and is now obvious to everyone? So transparency means that clean up at home first. If the cruise liner knew that there were issues with this captain, and allegedly that there have been things happened before and sightings before, they should have cleaned up house, and then that would never have happened. So I think the lesson for businesses is, take these things, learn from them, step up straight away, own them, do crisis management in social media and traditional media, and change your processes so that the family members will never have an opportunity to expose the fact that you're not doing the right thing.
Well, Laurel, I'm sure you've given business a lot to think about today. Thank you very much for your time.
Thank you.
Well, that's all for the first edition of the Finance Quarter for 2012. As always, if you'd like to see any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Quarter icon. If you'd like to contact us, we're on Twitter at the address on your screen now, or you can drop us an email at thefinancequarter@your.abc.net.au. Thank you for watching, and we'll see you next time on the Finance Quarter.